Is the nation's housing recession a thing of the past? Joining us for this week's Smith Business Close-Up is Cliff Rossi, Executive in Residence and Tizer Teaching Fellow at the Robert H. Smith School of Business. Dr. Rossi, thanks for being with us.
Thank you.
State of the health of the real estate market, how are we doing?
We're actually doing comparatively well these days. Right now, the home prices are up. We're seeing home sales increasing. We're seeing inventories down, and it's all aligning very well with what we're seeing at the national level.
Now, it's not a tough comparison if we're looking back over the past few years, but we're not quite back to the peak in terms of activity or prices.
Oh, that's correct. We still have a long road ahead to get to that level. I think we're still down about 25% from peak home prices where they were in 2006. So that's a long recovery. At the same time, one of the things that we do see on the horizon is that there's just a bit of disparity between counties within the state of Maryland. So the Eastern Shore, for example, is still lagging quite a bit behind in terms of the amount of supply that's on the market, home sales, that sort of thing.
And we see that across the nation as well. There's parts of the U.S. that are roaring back, and particularly some that were the hardest hit.
Yeah, that's exactly right. That's why we like to say things like there is no such thing as a national housing market. There are actually 3,000 housing markets, and the same is true for the state of Maryland.
Who's doing well within Maryland?
Well, not surprisingly, those counties that are doing particularly well are, in some cases, those that were hardest hit, or those that actually survived it fairly well. So Montgomery County, for example, no surprise, it's doing well. I think home prices are up year over year, something like about 8%. Baltimore City is actually doing very well in terms of home prices. But then again, if you look at some place like Kent County over on the Eastern Shore, home prices are actually down quite a bit, and they haven't had much movement in terms of sales over the last year.
From the perspective of somebody trying to buy a house, maybe a first property, get a mortgage, interest rates are fabulous, unheard of low levels, but it's gotten more difficult to get a loan. You used to run risk management for consumer lending at Citigroup. What are you seeing with the banks these days?
Well, the banks have, credit lending has been tight in the years after the financial crisis, no question. I think you're starting to see them lighten up a little bit. One of the things that I think everybody has to keep in mind, however, is that the types of mortgage products that were being provided in the years leading up to the crisis, up to, let's say, 2007 and 2008, that's a thing of the past. I like to characterize
zero down, subprime, all that stuff?
Yeah, all that stuff is effectively gone, and it will continue to be that way. We're really in more of what I would characterize as a back-to-the-future type of mortgage environment, doing things the right way, in a prudent way. And I think what that means for the home buyer is that they need to make sure that their credit is clean, that they come in with 10, 15% down payments, unless you're going with an FHA type of loan, and that you have the income to support the loan.
What's your view of what happens whenever the Federal Reserve stops keeping long-term interest rates this low?
Well, I mean, eventually we know rates are going to be on a glide path upward over the next year or so, but we expect that to happen at the earliest, probably sometime third, maybe fourth quarter of this year. At the same time, inevitably, that will be tied to how mortgage rates go. Mortgage rates are usually tied to something like 10-year Treasury, so we could expect to see a little bit upward pressure, but it will still be a very good environment for borrowers seeking their first home or seeking to move up in their home to get a new one.
All right, Cliff Rossi joining us from the Smith School of Business. Thank you very much.
Thank you.